Hello there! Tutorial Series 1 of Bite-Sized Corporate Reporting will look at a question on tangible non-current asset. This is a three-part tutorial series. Please note a link to the question is included in the description. We will start by looking at the question requirement, which is to discuss with suitable calculation how the building should be accounted in the financial statements of ABC Limited. Important, deal with both parts of the question, that is the discussion and the calculation. Also, pay close attention to accounting periods you are required to deal with in the question. In this case, we are looking at financial year ended 30th June 2019, 2020 and 2021. Here, we are dealing with an item of property purchased, and as such, we can narrow it to two possible standards, either IAS 16 if its owner occupied, or IAS 40 if it's for rental to others, or capital appreciation, or both. In this case, as the building was acquired to be used as ABC Limited's administrative office, it is owner occupied. This means the building falls within the scope of IAS 16. Further, it meets the recognition criteria set out in IAS 16. That is, it's able to generate economic benefit for more than one period, given the estimated useful life of the building is 30 years. Next, we need to deal with the issue in the question, that is, how to account for the building. Thus, we need to discuss the measurement principles of IAS 16, both on initial and subsequent measurement, given we are looking at the financial year end of 30th June 2019, 2020 and 2021. The building was acquired on 1st January 2019, and on initial recognition, it should be measured at cost. Subsequently, ABC Limited has a choice of adopting either the cost model or the revaluation model. On initial recognition, ABC Limited should recognize a total cost of 10.5 million, comprising of the following: purchase cost comprising purchase price of 10 million and stamp duty of 450,000. Legal fee of 50,000 being directly attributable costs of bringing the building to working condition for intended use. What about the renovation costs? There are two possible accounting treatments, that is, to either expense it off or capitalize the amount. Any subsequent expenditure should be added to the carrying value of the building, meaning capitalized, if it is probable that future economic benefits associated with the building in excess of its originally assessed standard of performance will flow to the entity. Therefore, the renovation costs incurred should be capitalized, as it is an enhancement to the building, given the building was left by the previous occupant in an untenantable condition. The renovation was necessary to bring the building to the condition for intended use and result in probable future economic benefits in excess of the originally assessed standard of performance. How about subsequent measurement? ABC Limited has a choice of adopting either the cost model, in which case the building is carried at cost less accumulated depreciation and impairment losses. However, if ABC Limited wishes to adopt the revaluation model, the building should be carried at fair value less any subsequent depreciation and impairment losses. Additionally, if the revaluation model is adopted, ABC Limited should note that any future purchase of building falling within the scope of IAS 16 will also be subject to the revaluation model. In the second part of Tutorial Series 1, we will look at the application of the measurement principles set out in IAS 16 Property, Plant and Equipment, focusing on the question requirement of discussion with suitable calculation.